Thank you guys for joining me tonight. My name is Jason Bergquist. I'm grateful that you guys are out there looking for retirement information. We are going to talk tonight about how to survive in retirement without running out of money. As I talk to people every day, it seems like it's more of a worry on people's minds about not running out of money in retirement than it even is about dying, right? Because how great is a lifestyle if you run out of money while you're in your golden years, right? So let's jump into this. So first off, let's talk a little bit about who this presentation is for. When I say individuals and families, what I mean about this is, yes, this is obviously something that is for you. But a lot of times when I'm talking to individuals, we're talking about them and their spouse. Maybe they're helping take care of a parent at this time. And then for their families, right? This is your time. You've raised your family. You've gotten to moved on. So now it's time for you. But a lot of people are looking to figure out a way to leave a legacy. So we're going to talk a lot about what we can do for you personally, you and your spouse, but then also what you might be looking for in how to leave a legacy for your family as well. Small business owners, this is a great presentation. One, mainly because I'm a small business owner. So I know what you're going through. I know the struggles that you have. I know what you don't have access to. I know you don't have the benefits that a big company can have. And then you're not an individual. So how can I make this or that work? We're going to talk a lot about some different out of the box ways that you can benefit yourself and maybe even some of your employees and have your own controllable plan that helps you as a business owner. And we're going to talk some tax strategies. And then high net worth individuals. Most high net worth individuals are already working with different planners, different CPAs, maybe even attorneys. But I really have some outside of the box ways of looking at a couple of different things that a lot of advisors out there in the industry don't do. So at the same time, who is this presentation not for? Well, this is not a get rich quick scheme. If you got on here to figure out the latest and greatest, what can I do to try and turn a small amount of money into a large amount of money overnight? Sorry, guys, that's not the way that I do this. This is not really what this presentation is about. I'm not really even talking about stock picks. So if that's something you're looking for, go join Motley Fool, look at some of the other ones that are out there. There's some great services, but that's not the route we're going tonight. And then Bitcoin, cryptocurrency. I'd love to have a conversation about it. I'd love to get your input about it. I have my own personal opinions on it, but this conversation tonight doesn't include those either. So the goal of this presentation. The goal of this presentation for me is to show you the only way to have a successful retirement is through 5 critical steps. And those things that you must do to put those steps in place, as well as what I think is one of the most tax efficient, safe manners to help you grow and protect your money in retirement. So that's kind of my 2 main points and my 2 goals that I'm trying to do to show you throughout this presentation. And if I can potentially help you save hundreds of thousands of dollars in taxes in retirement, you may be thinking hundreds of thousands, that's way too much, Jason. There's no way. Well, it could be. And that could be something that could be the case for you personally. So let's jump into it. One of the ideas and one of the subjects that I subscribe to and that I teach all of my clients is this concept called the power of zero. And you can see below that, it says the 0% tax bracket. So you may think that that's a misnomer or there's no way that can be possible or how can you be in the 0% tax bracket? But there is a way to get you, once you're in retirement and anything that you've done and saved up for retirement, to help you get into the lowest tax bracket possible. And as much money as we can possibly get into the 0% tax bracket is what we're pushing for. I think that's what's going to help you fulfill your retirement dreams, right? If you could take the taxes off the table, how big of a difference would that make to the money in your pocket, right? And then, of course, we're going to discuss how do we not outlive our money. So the importance that we're going to focus on is protected income, okay? So how we're going to get the income that we have coming in protected throughout our retirement. So we really want to figure out how we can spend more money in retirement, right? There's an awesome book out there called Paychecks to Playchecks. And the concept simply is when we retire, a lot of people think they're going to spend less money. But I ask people all the time, when did you spend the most money? And while you were working and everything, and it was your days off, right? Usually a Saturday for most of us. So your weekends end up being the most expensive time. Well, if you're not working and you're retired, then every day is a Saturday, right? And so those paychecks becoming playchecks, most of my retirees I'm talking to are spending the same amount, if not more, in retirement. So that comment down there below says, in today's volatile environment, many Americans are running out of money in retirement, and it's because the way we've been taught to save and spend money is all wrong. It's not about the total number, the total big overarching asset number that you have gathered or gained throughout your life, but rather it's how you're going to turn those assets into income. Okay. So I've got a couple of things that I'm offering free of charge just to kind of throw your guys' way, to kind of give you some information, to give you some things you can look at, some things you can go over. I've got a couple of reports. I've got the ultimate guide to the retirement of your dreams, all things that are free giveaways, no cost to you, just for staying here to the end. So finish out, listen to what I have to say, soak in whatever you want, whatever you can, whatever distractions are going on. But at the end, just let us know that you want these and we're going to get these to you. So a disclaimer real quick, I've got to throw this in there. I am not a licensed CPA, accountant, tax attorney, or any of those things. There's a lot of conversation that we're going to have in this presentation about tax, a lot of ideas on what you can do financially, but these are just generic educational ideas and tax concepts, okay? So I'm not providing any individual advice for you personally because, well, I don't know you personally yet. I don't know your story. I don't know your situation. And until I know that, I can't make a personalized plan for you. So now that we get the legal jargon out of the way, let me tell you a little bit about me. Again, my name is Jason Berquist. I live in Salt Lake City, Utah. I am on my second marriage, and together we have raised 6 kids and two grandkids. Love what I do. When I'm not working, my wife and I love to vacation. I mean, who doesn't, right? Most people do. And then on top of that, my third love is my Jeep. And this is something that I spend as much time doing as I possibly can. Anybody who's on here who happens to have a built out 4x4 machine rig, would be an awesome conversation. I'd love to talk with you about it. But that's a little bit about me currently. I have been in the financial services industry since the year 2000. So I'm in my 21st year of helping people out. I really look at myself as the financial educator. I don't do anything for anybody without educating them and making sure that they understand what they're doing and what they're getting themselves into. After doing this for 20 plus years, I realized that the education and the understanding is unbeatable. So you can see in blue there underneath my name, my tagline is helping you create the retirement of your dreams. You can find me at jasonbfinancial.com. But one I think that has even more information and is based as an educational way, and I'm going to talk about it throughout this presentation, is go to retirementofyourdreams.com. Todd, if you can type that in the chat for everybody so they have that link available to them after I change from the slide. I am an independent financial professional. I don't work under any umbrella currently, which means that I am a middleman. It allows me to be able to work with you in any situation in regard to what you're looking for. It allows me to have access to any of the products and services that are out there. I'm a wealth coach and I'm a CFF. CFS stands for Certified Financial Fiduciary. A lot of people ask these days, if you're a fiduciary, and my answer is I'm not just a fiduciary by license, but I've gone the extra step to certify myself and add that certification where that's something I have to keep up. So tonight, I want to empower you to create the retirement of your dreams. And we're going to start real quick with a fun little video. So in this video, this is a movie called Night and Day. It is Cameron Diaz and Tom Cruise. And if you just kind of listen to what he says, people are after Cameron Diaz. And of course, Tom Cruise is the hero, right? And he's telling her what her success options are, if he's listening to her. So I'm going to play this real quick. Hopefully the audio comes through and you guys can hear it on your end.
Your life expectancy is like here. With me, it's here. Without me, here. With me, without me. With me, without me.
So if you caught that, what he said was, your life expectancy is here with me. Without me, with me. Does that a couple of times. So what am I saying? Am I saying that your success in your retirement planning is only 96% if you're talking to me and 4% if you're not? No, I'm not saying that. What I'm saying that is if you're working with a financial professional, it is definitely going to help you reach your goals, meet your goals, exceed your goals. The example that I use is this. When your mouth hurts and your teeth hurt, something's going on, you go see a dentist, right? And you see that dentist and they work on you. And sometimes they're going to refer you to an orthodontist because you need a different expertise. Well, I think it's the same way in your finances. You really need to have a different expertise depending on what it is that you're looking for, or what it is that you're trying to accomplish. What do I mean by that? Well, what I am really honing in on in my practice, and for the past 3 years, what I have focused on is being a distribution expert. So I have worked at Merrill Lynch. I have helped people grow their assets. I've been that traditional financial planner. I understand those things and those concepts. But really in the past 3 years, I've really changed my focus. And I'm specifically working on how can I help people on the distribution side? How can I make sure that you have all the money you need to last you for the rest of your life, no matter what life or our economy or a pandemic throws at you? So let me tell you what that means and what I mean by being a distribution expert. And just real quick, I'm not saying that you should fire your financial advisor or get rid of them or replace them with me. I'm saying you need a dentist and an orthodontist, right? So you just need a different expertise to help you with a different part of your plan, and using us together can be a great option. And here's why I think we're looking at the change in what's happened over the past 15, 20 years is because that traditional retirement model where you used to have a pension, it's kind of that base, Social Security, and between the two, you could practically live for as long as you need to off of the money you need for as long as you're going to be around. And your savings on top was really just discretionary funds, allow you to go play and do the things that you want to do. But really, that's kind of been flipped upside down. And right now, most of people's retirement is on them. It's what have you done? What have you saved? What have you grown? And do you understand where it was and how it works and what you're going to get out of that in your future? Then we do have Social Security, and it is a big part of retirement as long as we get what we think we're going to get. If you're already taking Social Security, great, right? But if we're still waiting to file for Social Security, that's something we need to talk about. And for, I'll just give it away. I'm 43 years old. By the time I qualify for Social Security, I don't even know if it's going to be around. So we've really got to focus on other things. And then pension on the bottom, because most pensions have gone away. If you've got one, that's awesome. That's great. That's such a huge benefit. And we're going to talk about that here in a minute. But look at these headlines, right? Most people, again, they're worried about running out of money. Americans don't have enough in their retirement. Single women most likely to face retirement shortfall income. It's looking kind of glum if we don't figure out how we're going to do it ourselves. This is an old commercial from ING. And really, again, their focus was the older gentleman. He's looking at the younger gentleman. He's got more in his 401k or his employer plan than the older gentleman, right? And again, that's not what my focus is. And that's not what I don't think you have to focus on. But then you change the channel on your TV and it's a whole different concept, right? You've got Dave Ramsey saying, cut up your credit cards, don't have a house payment. Which pieces do we go with, right? What do we follow? What do we subscribe to? How do we make sure it works? Then you look at Mad Money, and he's just going to hit that button and tell you which stock to get, right? And then you're going to go buy that stock, and that's what's going to make you a millionaire. Well, let me tell you a little bit why I'm passionate about this. Everybody has a story, and I love hearing people's stories. And as I talk to people, there's so many different things that are out there. And again, an individualized plan is the only way that it works. There's no generic plan that's going to work for all 50 of you on this call, on this webinar. I mean, it just doesn't work that way. So one quick story. I had a couple that I was working with in the state of Alaska, and the husband and wife are already both taking Social Security. The husband worked for the state of Alaska. He had a great pension and 401k and everything going on up there. We were talking about when to put those things in place, he was going to retire, how he had access to it, how to get, so on and so on. This was in the month of November. He planned to retire in April, and we were going to have everything in place. We already had it all set up. We knew exactly what we were going to do at each step. You guys, I got a devastating phone call in December from the wife who told me that her husband had been killed in a head-on car accident, and she was devastated. But the one thing that was beneficial to the whole story was that she didn't have to worry about the financial side. Yeah, we had to make some changes, and yeah, we had to tweak some things, and yeah, we had to set this up differently, but the plan was there, and it was already being run, and we already knew what the steps were. We just had to change them and put some things in place a little bit quicker. So there's good stories, there's bad stories. This one's kind of a mix between good financially, sad, emotionally. But we just don't know. We don't know what's going to happen out there. And, I've got stories from both sides where people did it and it was great. And we have others who didn't take care of it and the financial devastation that comes from it. So I'm passionate about making sure that everybody's talking to somebody, making sure that all of their affairs are in order. Okay, so tonight, what we're going to focus on, there's a lot of retirement risks, but I want to focus on 4 main risks. We're going to talk about income taxes and how that can be the biggest expense in your entire retirement. We're going to talk about the stock market and all the crazy ups and downs that come with the stock market. And then inflation, right? How we're going to make sure that we have enough money coming in today, 10, 20, 30 years from now. And then the 4th one, longevity. Longevity is the multiplier, okay? So the longer you live, the more all of these risks come into play. So how are we going to address those? Well, first off, remember, it's not about how much you save. It's about how much you get to spend, right? Isn't that a much better way to look at it? How much do I get to spend? What do I get to do in my retirement years, right? How do I make sure that my savings and spendings is right? How do I make sure that it's not about the just total dollar amount of assets that I've grown, but how do I turn those assets into income? So remember, the only way for a successful retirement plan is through an income plan that protects your money from those 4 key risks. So this is going to be our retirement income framework. And really what we're talking about is the quickest way to get from point A to point B. This is a friend of, is now a friend of mine. This is a referral to me from our CPA. And I was so glad that we got in touch. She was in her early 30s. She had just gone through a divorce. She had 2 kids. And, she's like, why am I talking to you, Jason, about retirement planning? And I said, retirement planning needs to start as soon as you can, right? It's not just the fact that once I'm looking to retire or I'm at 50 or at 65 or whatever, then I figure out my retirement plan. Retirement planning starts as young as possible and making sure that we're doing the right things that we can. So a little bit about me. About 10 years into my first marriage, I started having some issues and we were going through a divorce. And I tell you that because as I was going through that divorce, I was really kind of the low of my financial life. And I thought to myself, I have been teaching at this point, I've been teaching financial concepts for about 10 years to people, but I hadn't always taken those concepts and applied them in my own life. And I vowed from that point on that I was definitely going to put all of those things in place. And so going through a divorce, going through that financial hardship, understanding what people have gone through. When I met with Marissa, I totally understood what she was going through, how to understand and what to do with the finances, and then what to do differently for an individual and what to do going forward. So my idea is we want to make sure that you can spend confidently regardless of the economy, right? So here's the 5 quick steps that we're going to go through tonight. And I don't have time to go through all of them in depth. So we're just going to kind of buzz through them, touch on them, and then we got other ways that we can go into more depth. So first off, we want to identify. So who has a junk drawer in their house? And does it look like this? Well, I think almost everybody does, right? And as we throw everything in that junk drawer, you can see there's some important things in there, right? Keys, glasses, medicine. But when it's in there, it looks like it's just a mess. And now we got to dig through it. Sometimes we can't find the important things because they're covered up by all the other clutter. Well, I think we have the same thing for most people when it comes to their finances. They have a junk drawer of finances, right? You get a statement, you get some information, you get Social Security, you get whatever it is that's coming to you, and you just throw it in this drawer or in this filing cabinet, right? And you're like, I don't know, I haven't even looked at it. I know something came, but I just filed it away. Well, as I'm working with people and talking to people, and I'm asking these questions, well, do you know what you're going to get from Social Security? What do you have in savings? And then they're like, oh, I don't know, I've got some 401k thing over here. I started an IRA at one point, but I don't know what's in it. Yeah, I've got some life insurance, but I think it's only through work. So I don't know. My job is to help you declutter that. It doesn't do us any good to kind of put our head in the sand and be like an ostrich, right? And, if I can't see it, then it's not a problem. Let's open that junk drawer. Let's go through those files. Let's make sure we understand what you have, so we can build on that and structure it the right way. This is a comment from a Nobel Prize winner, Robert C. Merton. His comment is, our approach to savings is all wrong. We need to think about monthly income, not net worth. And I know that's a mind shift change for most people I talk to. So how can I help you make that mind shift change? Here's what we're gonna do. We're gonna ask 2 simple questions, okay? First one is, what do I need my retirement income to do? And you can see above that it says essentials. So what I mean by that and what we're looking for, right, is what I need my retirement to do is cover my expenses. If I'm not going to work and trading hours for dollars, I have these funds coming in, but I have expenses going out. If my retirement guaranteed monthly income coming in from my retirement structures, wherever they're coming from, Social Security, pension, your own plans, right? If I have enough coming in every single month to cover my expenses going out, man, that's going to make our retirement so much more peaceful, right? Less stress. And then we're going to look on the other side. And then we're going to look at discretionary, right? What do I want my retirement to do? What other travels? What other things do I want to do with my family? Do I want to take my kids and grandkids to Disney World each year, right? We're going to discuss that after we make sure that the stress-free part is taken care of. So let's just throw a couple numbers at it. Let's say I need $5,000 per month coming in every single month for the rest of my life, adjusted with inflation, to make sure that I never go without. And then I would love to have an additional $2,000 a month that I can just bank up and utilize to spoil my grandkids, or finally my spouse and I can travel around the world that we haven't been able to do while we've been working. So we're going to call this fixed number, right? The fixed income that we need, we're going to call it our protected income number. And we're going to use that phrase because it's going to go along with the report that we get, okay? So we have a protected income number that we need to make sure it's coming in every single month. So now that we've identified where we're at, we got to figure out how we're going to protect it. So Time Magazine said securing at least a base level of income, lifetime income, should be every retiree's priority, at least if they want to live happily ever after, right? Going back to what I said before, this is just going to help you have a stress-free retirement if you know that you have guaranteed lifetime income coming in that cover your expenses. So quick story here. There's 4 friends who lived on the East Coast who had some crazy desire to fly out to California and drive through Death Valley. It's something that was on their bucket list they wanted to do. So they finally got it together. They figured it out. They hopped a plane. They flew out to California. They rented a car and they're cruising down through this, right? But they're loving it because it's checking it off their bucket list, and they're cruising through Death Valley. You know, it's the middle of the summer. It's 120 degrees outside, but they've got no care in the world. They're having fun. Music's blaring, air conditioning's going, everything's great. And then they come across a sign and it says 115 miles to the next gas station. They look down at their gas meter and they're like, oh boy, I don't know if we're going to make it to that gas station. We didn't quite plan that one right. So now everybody kind of starts freaking out. Everybody's throwing their ideas out there and telling the driver, hey, you need to go as fast as you can so we can get as far as possible. Then we can coast as far as we want. Others are like, hey, before we do that, we've got to roll down the windows and turn the AC off because that lowers our miles per gallon. Other people are like, no, don't push on the gas. That wastes more gas, right? We need to figure out the exact speed we should be going so we can figure out how to get to our destination without running out of gas. Well, why do I tell you this story? Well, as I talk to people, it seems like that's what they feel like when it comes to retirement. Everybody's throwing these ideas by them, right? They're seeing all this stuff on TV. One friend's telling them this. Their parents are telling them that. Their kids might be telling them this. They Google something and they see exact opposite answers for the exact same thing, right? There's just so much stuff that's being thrown at you as you're trying to get retired and trying to figure out what to do with your money. Well, if we look at it this way, we look at creating a plan, setting up a plan, having it based on something, right? So you can see here that this is if you're retiring at 65, that means that the average lifespan for a male is lasting about 18 years after they turn 65. Females, a little bit longer. Couples, last even longer. So even if we look at this and we say, all right, well, let's make sure that we have a 25-year plan in place. And if we're 65, that's going to take us to 90. Well, that sounds pretty good, right? 25-year plan. Well, kind of, right? What happens if you live past 90 and your plan was played out exactly to have the money you need until you turn 90? Well, then what, right? Here's what we want to do. We want to make sure we have a plan that's going to last as long as we last, right? We don't have an end date to it. It is what it is. It's going to get to us to wherever it is it's going to get us. So how do we make sure we have that protected income? Well, first off, remember, we want it to be guaranteed for life, whatever that lifespan is. We want it backed by a government or a financial institution so that we know there's some sort of guarantee to it, right? We want it and need it to increase over time with inflation, right? Because $1,000 a month right now is not going to buy the same amount of goods for $1,000 in 10 years from now. If we just look at what inflation's done in the US history, on average, it's 2 to 3%. If we look at what's happened over the past year and a half, 5 years, right? Man, I don't know about you guys, but just watching the gas prices it's crazy, right? If you remember what you used to buy bread for and sugar for, milk for, right? It's all so crazy. The best one I think is if you think about what your first house cost you, and if you think about what the last car you bought cost you, that shows you what our inflation is, right? So we've got to make sure that the money that's coming in today is covering us with inflation, because I don't want $1,000 coming in today and then in 20 years from now I still have $1,000 coming in, but it only covers a third of my bills at that point. And then we need the money to increase over time, year after year, whenever it is that we're not using it. So how do we do that? Well, that really comes from 3 sources. We have a pension. If you have it, great. We're not really going to touch on that much because a lot of those have gone away. If you've got it, great. There is some worries about pensions. There are some pensions that have gone bankrupt. People that were counting on those pension payouts for the rest of their life, and now that company's gone or the pension was mismanaged. There is some options with pensions where you could turn that into something that you control. So there's that if we need to. We're going to talk about Social Security, and then we're also going to talk about an annuity. So a little bit about Social Security. With Social Security, you can see that this being our example. If at 62, you had $1,500 a month coming in, FRA stands for full retirement age, and that's going to be somewhere between 66 and 67, depending on the year you were born. And when I ask people, how do you maximize your Social Security, I get answers all over the place, right? Most people are saying, everybody tells me to take it as soon as possible. Others are like 65. Well, where do you get 65 from? Few people know the full retirement age verbiage. And then you've got this 70. So how do you know when you should take it? Because 1,562 and 2,640 at 70, my Social Security is going to increase by that every year? No. These are what you're going to get if you take it at that age. Now, Social Security increases by 8% every year that you don't take it. So on average, there are a couple exceptions to the rule, but on average, that's going to start at 62. No matter what, 70 is the end date, right? So if you wait until you're 71 to turn on Social Security, you get the same amount of money as if you to turn it on a year earlier at 70. Now, again, a lot of people ask me, well, so when's the best time to take it? If I take $1,500 at 62, I'm taking income 8 years longer than if I wait till I'm 70. So how would 62 not be my best bet? Well, we'll run a Social Security maximizer report, but I'll give you a cheat real quick. Almost all of the Social Security maximizer reports show you that between 62 and 70, if you took it at 62 or you took it at 70, that 80 or 81 is that marker. That is where you have your break-even point. So if you live to be 80, then it's almost the same amount of money that had come into you if you took it at 62 or 70. If you live to be 75, you'd have been better off taking it at 62. If you live past 80, you'd have more money coming in if you had waited until you were 70 and took the higher amount, okay? And we're gonna do that report for you so you can see it. One thing about Social Security, again, when you're not taking it, it's grown by 8% per year. Once you do take it, then it's only grown by that COLA, that cost of living increase. And that cost of living increase for Social Security has only been less than 1% to as high as maybe 2%. And like I said, inflation is about 2 to 3%. So what your cost of living increase on your Social Security isn't even keeping up with the inflation. So you're actually kind of going backwards. So that's why we need to make sure that we figure it out and we take it properly. There's about 567 different ways to take Social Security. I talk to people every day, right? Do I take it for me? Do I take it for my spouse? Do I wait for one? Do I push one to 70? Can I get more? Can I switch it along the way? There's a lot of different confusions about it. So here's an example, right? You can see if you would have taken that $1,500 a month at age 62 and you lived to be 95, there's that idea I was telling you about after 80, right? You would have pulled in about $864,000, including your cost of living increases. If you waited till you're 70 and took the higher amount, taking 8 years less payments, but took a higher dollar amount, 1.25, crazy, right? Almost $400,000 more. But there are definitely times when I suggest people take their Social Security as soon as possible. One, if you need the money, you need the money. We take it, right? But also it comes a lot along the lines of health and longevity in their family. And again, if you don't think you're going to make it to 80, then you might as well take it earlier. So a lot of different ways. Here's what Social Security says themselves. If you log in and see this on their own website, Social Security benefits are not intended to be your only income source when you retire. On average, Social Security replaces about 40% of your annual pre-retirement earnings. In other words, if you're used to having $100,000 come in income, and your income goes away and you turn on your Social Security, that's only going to bring in about $40,000 a year. So you've got to make up the other 60 off of your own savings, your own investments, your own pensions, your own retirement plans. So we've got to figure out what we're going to do in addition to that. Okay. Last but not least here, an annuity. Now, don't log off because I said the word annuity. There's been a lot of bad information out there, a lot of old information out there. So let me just give you a little bit of information on this. So one, what is an annuity? It's a personal Social Security-like stream of guaranteed lifetime income from a top-rated insurance company. So again, if you could buy a pension, if you could get a second Social Security, would you do it? Well, if we're looking for that guaranteed lifetime income, right? A guarantee that's going to pay out for no matter how long I live. Well, that's what we're looking for. Now, if you still say, no, Jason, sorry, annuities, not my thing, I'm not even sure why I got on this webinar if that's what you're talking about. Well, then when you get that Social Security check, why don't you send it back to Social Security? Tell them, hey, I don't believe in annuities. I don't like annuities. I don't do annuities. You can keep this money. Because Social Security, that's just the government's annuity. Your pension, if you get a pension check, you're like, send that pension money back to that company. Because guess what? You don't do annuities. You don't like annuities. That's not your thing. Because the company has set their pension up to where it's set up as an annuity. You're getting a lifetime guaranteed payout. So basically, these are all annuities. When I say the word annuity, what I want you to think of is a guaranteed lifetime income. That's it. That's what we're focused on. Now, to find the best structured one out there, yeah, of course. So annuities, if we can have an annuity that has a 6% guaranteed increase every single year, okay? Now we're covering that inflation part, right? We have an increase when we're not taking it. It has the ability to increase even once we're taking income. Now, again, a lot of people look at me and say, okay, Jason, hold on. I've heard with annuities that it limits our liquidity. I don't have access to my funds. There's all these surrender charges. I don't even know how those come into play. There's these fees that are attached to it. People say stay away because they're too expensive. But maybe that's the way it was 10, 15 years ago. Maybe they didn't buy the right annuity. But let me tell you this. You can get annuities that have 100% liquidity. Return of premium, no problem. Surrender charges, yes, we have to figure out how those work and how those play into it and the best structure on that, but not in the sense that you don't have access to your money. Fees, okay. There are no fees, zero fees, no fees in a fixed indexed annuity. Are there charges? Sure, they're called rider charges. It's not a fee. The reason it's not a fee and it's a rider charge is because it's something that you pick. You can have a completely no fee product. But if you say, okay, Jason, I want to make sure I have guaranteed lifetime income. I want to make sure I have a death benefit. I want to make sure that I can cover medical problems if they come up. I would love to have a doubler on my money. Those are just riders that you add to it. It's similar to car insurance. In car insurance, you have the option, right? Do I want a small deductible and a high monthly payment? Or do I want this high deductible and a low? I said that backwards, but you get the point, right? You choose. Do I want to be based on my monthly payment, or do I want how much coverage I have on my vehicle in case of an accident? You choose that cost, okay? Also, another example I have with annuities is they're like computers. There is so much out there and so many companies who offer multiple different options that they change like computers. What you bought in a computer 4, 5, 6 years ago isn't even close to what you can get in a computer today. And being that I'm a middleman, I have the ability to have all these annuity companies always throwing at me, hey, this is the best thing on the block today. Hey, this is the best thing that's going right now. Hey, we've added a new guarantee. Hey, we've made it easier for your client. And they're always competing, and that's a good thing. It's a good thing they're competing because they're trying to make their products better for you. Okay, enough on that. So then we've got to talk about reducing. So, okay, find your chat feature. I got a couple questions for you on this story here real quick. So this is you going into the bank needing a $50,000 loan. And you walk into the bank and you tell the banker you need a $50,000 loan. And he says, awesome. You've been a great client here. You've got money with us. I know you. Yeah, you betcha. And I'll write you a $50,000 check and hand it to you and say, all right, there you go. Thank you. There you guys are covered. Would you just take that check and walk out? Or do you have a couple questions you're wondering about? Give me a response in the chat over there real quick. Okay. A couple questions coming in. Let me get a last drink while you guys type a couple more questions in. Okay. Everybody's typing the same thing, right? Well, no, I wouldn't just take the check and walk away, right? I mean, what's the interest rate? When am I supposed to pay this back? When does this loan come due? Is there a prepayment penalty, right? Same things, right? You borrowed money, you want to know what that contract looks like for that borrowed money. Well, what if your banker's answer is, oh, don't worry about it, right? When we need that money and we call on that money, we'll just let you know what you owe us at that time. Everybody's laughing, right? Yeah, right. No way. Of course not. Yeah, that doesn't work, right? Well, what if I told you that that's how one of your contracts works, right? That you are locking hands and you are saying, well, anything I haven't paid taxes on now, tax deferred plans, qualified plans, employer plans, right? IRAs, 401ks, anything where you have deferred our taxes on, we have procrastinated when we're paying our taxes, we have pushed off that tax, we want the tax benefit today, right? We get more of a write-off. Well, guess what? You have locked your hands with the government, with the IRS, and saying that when that money comes due, when that money is used, I'll charge you whatever it is I decide I want to charge you at that time. Meaning that you're going to pay the taxes at whatever rate the tax year is at that point. So do you believe taxes are going up or going down? Do you believe that we are in a low tax rate right now? Now, most people don't think that we're in low tax, right? It seems like taxes are ridiculous, that they're always too much. Well, and it's true, right? Anything that costs us something or takes money out of our pockets, too much. But overall, we are at one of the lowest all-time marginal tax rates ever in the history. And so right now, if you're choosing not to pay the taxes on the funds that are coming in, if you're deferring those taxes, if you're procrastinating when you're paying those taxes, well, you're going to pay that tax bill when you start pulling that money out. And when you start pulling that money out, if our tax rates have gone from our highest marginal tax rate right now, 37%, and they go back up to that 50, 60% that they have been in the past, and that but people believe they're going to be again, you don't have a choice. You've signed this contract, you've locked yourself in, you have a contract with the government, with the IRS, without any terms. And you're just going to take it in the shorts. They're going to say, this is what you owe us. And you're going to pay it because you don't have a choice. So we need to talk a little bit about what we can do with our taxes. If you're familiar with the Tax Cut and Jobs Act, you can see that at the beginning of 2017, our tax rates were reduced. Well, this Tax Cut and Job Act is going away. It's going to end. It's going to end more than likely at the end of 2025. So January 1st, 2026, all of our tax rates are going up unless they make a change to it. There's been some conversation about extending it, but we've heard all of the tax increases coming. This is one that's happening no matter what. If nobody does anything, it's going to go back to these rates that you see on the left side starting January 1st, 2026. And that's if they only go up to that. Well, maybe you're thinking to yourself, well, I've heard a lot of people say, no, our taxes are going to be less in the future, right? I have less income coming in. And that's the case. A lot of people I talk to, we have this misnomer that's been taught for so many umpteen years that says that when I'm in retirement, my tax bill is less because I am making less. Well, guess what? When you're in your retirement years, there's a lot of deductions that you've been using throughout your working years that you don't get anymore. Your mortgage interest. Yes, if you still have mortgage interest, you do get to write it off. But if your home is paid off, because that's been a goal, right, is to get out of debt, you don't have any mortgage interest to write off. Guess what? Even if your kids and grandkids move back in with you, you don't get any child exemptions anymore. There's no deductions, no write-offs for that. If you're not contributing anymore to qualified plans, then none of that's there to offset your adjusted gross income either. So we have these three buckets. And if money is pouring out of these buckets from these holes, well, wouldn't you want to plug the holes and keep as much of your money as possible? We have taxable, we have tax deferred, which is I talk to people about 95% of everybody I talk to that says that they have money that's put away for retirement. Almost, I don't know, 80, 90% of those people, it's sitting in tax deferred accounts, meaning that they haven't paid taxes and they're going to pay taxes on all of that money in the future when they use it. So 401ks, IRAs, and so forth. But wouldn't we like tax-free? Wouldn't tax-free be the best option? Well, how are we going to get that money tax-free? Yes, we're going to pay income tax, right? We're going to pay money on the money we make. We're going to pay taxes on the money we make. But if we can have all of that money in the future come to us tax-free, no matter how much it grows, no matter how big it is, that everything that grows in the future all comes to us tax-free, isn't that going to help take care of some of our problems? One of those options is done through a Roth IRA. This is a tax advantage individual retirement account that has no income tax withdrawals. So no matter what level your Roth IRA has grown to when you are in retirement, when you start pulling money out of that Roth IRA, there's no taxes owed on that. Even if you got $100,000 into your Roth IRA and you let it sit and it grew and it grew and it grew, and you've got $400,000 in your Roth IRA, it's not like you're still owed taxes on that gain from 100 to 400, those $300,000, there's no taxes on that either. So what you put into it, your premiums, right? Your deposits plus interest, none of that is taxed. And if you make sure that you wait till after 59 and a half, there's no penalties, there's no taxes, no nothing. But there's a couple drawbacks to a Roth IRA. Well, if you can only contribute $6,000 or $7,000 per person, depending on your age, right? If you are 50 or older, they let you play catch up and you can do $7,000 per year per person. But if you're under 50, you can only put in $6,000 per year. Well, how can we get very much money into a Roth IRA then to make what we need in the future? There's not by just having contributions. But at the end of this, in my Q&A, I'm going to talk a little bit about Roth conversions, as somebody mentioned in our chat over here. Another one is called an index universal life. Now, you may see life insurance on the screen, and again, whatever, you're out, right? But listen real quick, okay? An IUL, or a cash value life insurance, is like a Roth on steroids. So it's a Roth-like IRA account with a unique combination of tax-deferred growth, tax-free distribution, and tax-free wealth transfer, meaning that you get all of the tax benefits that you would from a Roth IRA inside of a cash value life insurance plan. But you also get to transfer it wealth, no taxes when transferred to your beneficiaries. Also, you can put in a lot more money, basically really as much as you want to. There's no limit. There's also no 59 and a half rule. So that's another option. So you saw the indexing in there. One of the things that I teach about indexing is you should have an indexing strategy in your investment portfolio. Indexing strategies can fall underneath an insurance plan. They can fall underneath a annuity. They can fall underneath some employer plans or even some of your own personal investments. Index strategy just means that you have a floor. You can't go below what you put into the investment. And then when the market gains, you're going to get a percentage of the upside gain. But every time you get a percentage, maybe not the whole thing, that's your new floor and it's going to lock it in. So it's going to have the step up feature where it's going to step it up, lock it in at that base, and that's your new floor. You can't go below that. Well, if you look at the screen, if you have done something along the lines of this back in 2000, every time that market's up, you get some gain. When the market drops, you maintain where you're at. You don't lose at all. The market comes back up, you get to go back up from that point that you're at that time. So an indexing strategy is something everybody needs to have in their portfolio in one way or another. Now, when it comes to cash value life insurance, there's some other benefits. A couple examples here. Disney used it, that a large part of being able to collateralize what they needed to make ends meet as they were growing was to borrow money from the cash value life insurance plan. Jim Harbaugh, one of the highest paid college coaches out there. Whether you like college football, whether you like Jim Harbaugh or Michigan, whether you think he deserves it or not, whatever, right? He still is one of the highest paid coaches out there. But you can see here that one of the ways in which he structured that pay was a deferred comp package, which included cash value life insurance, specifically in an index universal life product. That's how he structured part of his package for his pay. Now, maybe you're thinking, well, why haven't I heard about this, Jason? And how is this part of retirement planning? Here's the main reason you haven't heard about it, is because most people are selling to the biggest crowd they can sell to. So the bottom 75 of income earners in the country versus the top 25 income earners in the country. The bottom 75%, that's a lot more people to market to, right? So that's where you see the Susie Ormans and the Dave Ramseys, that's who they're marketing to. But these people have an income problem. The top 25% have a tax problem. Well, and maybe you're thinking to yourself, well, I'm not in the top 25% earners in the country. I'm not paying 86% of the taxes that are being paid in our country. Well, how do you know? What qualifies you to be in the top 25% income earners in the country? Whether it's good or bad, I'm going to tell you. So this is as of 2020's numbers, but if you were to make as an adjusted gross income household between you and your spouse, if your household adjusted gross income is $83,682 or up, you're in the top 25% of income earners in the country, meaning that you're basically in the highest taxable position you can be in on who's charged taxes. If you guys together have a higher than a adjusted gross income of 145,000, you're in the top 10%. Now, one of the things that we'll talk about in a different scenario. Again, that site that Todd typed into the chat over there, retirementofyourdreams.com. I don't have time to go into every one of these things for you, but if you go to that website, each of these subjects that I'm just touching on in this webinar, I have its own individual 8 to 15 minute video in there. One of those is on this with Social Security and your provisional income. And did you know that your Social Security can be taxed? Well, I don't have time to get into that tonight, but go watch that video on retirementofyourdreams.com. Okay, now the investment part, right? Isn't this what everybody wanted to get to, right? We talk about investments. Well, if we got the stock market, right? The stock market's always a good place to be. Yes, we have some downturns, but there's always a return. Well, let's talk a little bit about that. And you can see here that the average investor versus the S&P 500, look how much lower the average investor is versus the S&P 500. If everybody's basing how things are going off the S&P 500, and if you say you can beat the S&P 500, you're doing good, that's true. Well, then how come most people aren't doing it? Well, here's what usually happens. As I talk to people, we all know this, right? Emotions come into our investments, right? Things are going up, things are looking good, I'm buying. Everybody in the world right now is talking about cryptocurrency, right? It's going nuts. You got to figure out the best Bitcoin, you've got to figure out the best cryptocurrency, you got to figure out the best blockchain, everybody's buying. Well, the problem is, as it starts to drop, we start to get out of it, right? Oh, it's hot again, I start to get back in. And this happens over and over throughout our lives. And we say to ourselves, okay, I know better, right? Buy low, sell high. Concept we all know, right? When things are on sale, we buy extra, we stock up. But we just can't seem to get this done in the stock market because it's so hard to see our money going down and not get away from it. And then when it's going back up, it's looking good, it's hard to decide that you shouldn't get in, that you want some of this. Literally in one of our licensing manuals, as we are studying to get licensed to give advice and help you guys out, one of the This is hilarious. One of the points that it says in there, in order to know what is the best way to follow the trends, it says do opposite of what the public is doing. So right now, what's the hottest thing out there, right? Maybe that's not where you should be. If we look at this in between our bear and bull markets, our down years and our good years throughout the history of the S&P 500 and its tracking, you look at that and you're thinking, wow, there's way more good, way more up, way longer periods where the market was up. So of course I want to be in the market. This is where I need to be. Well, it's more about the timing, right? Here, look at this. If you had $100,000 in the stock market, maybe just the S&P 500 index inside your 401k in 2000, and you didn't put any more money, right? You changed jobs, you didn't put any more money in that 401k or that IRA, whatever it is, and you had that in there in 2000. Well, the market dropped 3 years in a row in the early 2000s, and it came back. Then it dropped again in 2008 that we're all aware of, and then it came back. If you looked at this period, you didn't put any more money in, you didn't take any money out. 12 and a half years later, your 100,000 is still 100,000. It didn't go anywhere, right? We lost all that time. Yes, we haven't lost money yet, but well, we have, right? Because we didn't go anywhere over 12 and a half years. So you guys, it's really about the timing of when you're going to retire, not necessarily timing the market, right? If you have a set dollar amount that you can leave in forever till it gets to where you want it to get to, it's eventually going to get there. But the timing, if you wanted to retire in 2009, you probably didn't, right? Because your portfolio took such a hit in 2008 that you couldn't. Well, what if you'd retired in 2007? Your money's still in the market, you retire, everything's good, you can live off the funds that are coming in, and then your retirement funds are cut in half. People went back to work. So it's all about the timing, right? So the question is not if the market will crash, but when and how many times will that stock market crash, either during your retirement or just before your retirement. So how do we make sure that we manage that? How do we make sure that we set up for that? How do we make sure that you have a plan that's going to change as you do, as the market does, as the economy does, as pandemics hit, right? As your life changes, as your family changes? Well, let's go through what we discussed today. One, the current retirement model is broken. The only way for a successful retirement is through an income plan. But that income plan needs to make sure that it protects you from these main four risks. There's lots of risks, but these main four, right? Stock market. Does your income plan protect you from the ups and downs of the stock market? Does your income plan increase over time with inflation? Does your income plan take care of those taxes that are coming due? And again, last but not least, that longevity, that's that multiplier, right? If I'm going to live 10 or 20 or 30 or 35 or 40 years, that's the longevity. That's just going to be a multiplier. That's a 10x multiplier or a 20x multiplier. So those 5 steps that we went through are going to help us overcome those 4 risks. If we were to look at Warren Buffett, ask him his opinion, here's what he said. His number 1 rule about investing, never lose money. Rule number 2, don't forget rule number 1. Well, that's pretty simple, right? One of the most successful investors of all time. Okay, last story here real quick. And then we'll finish this out. If you were sitting on a plane and the pilot comes over the plane and says, thank you for flying Delta, and we know you could fly any airline. We appreciate you being on board here. It looks like we're going to be into Orlando in 4 or 5 hours. You're thinking to yourselves, man, they usually know pretty good about what time we're going to arrive. There's not usually an hour window. But then he follows up. He goes, well, the reason I'm not sure if it's going to be 4 or 5 is because it looks like there's some heavy turbulence along the way. And honestly, if I gave you my honest opinion, there's probably only a 20 or 30% chance that we're even going to land this plane. So you're gonna be like, oh, okay, no problem, right? This probably looks good. You know, you're just gonna sit there and you're gonna let the plane take off and you're just gonna take your chances. No, of course not, right? You're unbuckling your seatbelt, you're running off that plane, people are trampling over each other. You don't care if you get your money back, right? Because guess what? Why would you take a 20 or 30% chance with your life that you're gonna land this plane? Well, why do I tell you this story? Well, let's look at your retirement. Are you taking a 20 or 30% chance that your money's going to last as long as you need to? So are you taking a 70 or 80% chance that you're going to run out of money before you run out of life? Well, how do you figure that out, right? How do you even know? It's a guess on how long I'm going to live. So how am I supposed to make the right educated guess on what I need monetarily? Well, let's talk about it. Through a retirement income shortfall analysis, we can look over your scenario. We can project out, and this is something that comes in a PDF pamphlet type structure that I can send to you. It's something you can have access to. We can go through it together and we can say to ourselves, okay, if I keep doing what I'm doing, these are the percentages of me having the money I need for as long as I live. Or these are the percentages of I'm going to run out of money by this age. So I'm going to give you guys the opportunity to get that report, okay? As well as my ebook done by me that's called The Ultimate Guide to the Retirement of Your Dreams. Todd typed it in the link over there on the chat. That is the website. You go to shortfallanalysis.com. But let me tell you what you're going to get for that, okay? This report is going to give you your retirement success score. How awesome does that sound, right? A success score. Well, who doesn't want that, right? I want to know that I've got 100% success in my future. But it's also going to then tell you how that's going to work. It's going to give you that yearly breakdown, show you those different account withdrawals, show you when you start things, turn things on, whatever. We're going to find those shortfalls. We're going to get those notifications so we can figure out what we need to do to change it, and then how we're going to enhance and increase that score. So let me just give you an example. So this is a couple nearing retirement, male 55, female 52. Their current income is $150,000 a year. In retirement, they think that $120,000 a year coming in is going to be pretty good. Well, it's about 80% of what you had on your income. Great. Okay, let's work with it. They've already invested $1 million. They've been adding $30,000 a year to that. And we said, all of those things are awesome. You guys are well on your way. But do you know what your retirement score is? What do you mean retirement score? Well, the percentage that tells you that you can retire at 65 because this is going to last. So we sat down with them. We said, okay, look, if we look at what you have as protected guaranteed income for life, increasing with inflation, the only source that you currently have is your Social Security. So that's the only guaranteed income you have coming in. So what we suggested was if we reposition about $300,000 of your current $1 million assets into a fixed index annuity to give you another source of a guaranteed lifetime income payout, basically 2 Social Securities, okay? And then we looked at it and we said, okay, all of your assets are in this tax deferred bucket. You're not utilizing any tax-free sources. And like, what do you mean? What can I do to get tax-free money in my future? Well, that $30,000 that you're putting into your 401ks, well, let's just put that in a different place. You have way too much already in your tax deferred bucket. We need to start building the tax-free bucket. And they're like, well, yeah, for sure. Why not? So we're going to direct that $30,000 a year going into an index universal life policy to give you tax-free income when you need to pull those cash value out of that in the future. And then this was the hardest conversation. 100% of their funds, right? $1 million, $30,000 plus going into it each year. It's all in the market. It's all exposed to the market volatility. And sure, 55, they still got time, but you know, if their goal is to retire at 58, 59 and a half, we don't have a lot of time to deal with the ups and downs of the stock market. So we moved it to those protected income sources to help them establish and cover those essential expenses. And when we did that, we said, now how would you like your score? If you only had a 41% probability of outliving your money versus 95%, right? Which one's better, right? So 60% chance I'm going to live longer than my money lasts me. Well, if you look at it, that's saying average age, right? So for a male and a female, 80, 86, 87, whatever you want to call the average age, right? But if we live 10 years longer than that, that probability dropped to 26%. I only have a 25% chance that I'm going to actually still have money by the time I'm 90. If we just shift a couple of things, that probability basically all but goes to 100. I can't legally tell you 100. So it's going to last no matter how long I live. And because we've shifted into things that are going to give us guaranteed income payouts for as long as we live, well, it doesn't change things if I live 10 years longer than the average lifespan, because this is guaranteed for as long as I live. Well, one of the things that we have to make sure that we talk about are taxes. We talked a little bit about them. I'm going to touch on them again. Again, if you go to my website, retirementofyourdreams.com, I've got other videos on there about taxes. This is just a quick comment from David Walker. He was the former U.S. controller, basically the CPA of our country. He was there through 2 presidents. And this was over 10 years ago. He made this statement that we're going to have to either double our federal tax rates or cut our federal spending by 60%. Federal spending meaning Social Security benefits, Medicare benefits. We won't jump into this. It's insane what our debt has come to in this country. It's absolutely insane what's happened over the past year and a half. If you want to look it up, just go to the website, www.usdebtclock.org. If you want to type that in there too, Todd, that'll blow your mind. There's so much information in there. It's a constant ticker for you, usdebtclock.org. Okay, now, maybe you're asking yourselves, okay, Jason, what's in this for you, right? You're just giving me all this information, no obligation, no cost. Okay, well, let me tell you what. When you go to shortfallanalysis.com or through my website, retirementofyourdreams.com, if you click on either of those sites that take you to a chance to schedule either a call or a meeting or just an overview, whichever one you're looking for, what we're going to do is we're going to determine your latest account statements. We're going to calculate what that protected income number is. There's a client assessment form that we can either fill out together or we can send it to you ahead of time that you can get filled out. Todd's got access to those. We're going to send those out to you if you want those. That way you can start the process. And then when you look at this information, you can say, okay, Jason, I want that shortfall report. So send us that information. We can create that report for you. I'll give it to you. If you want to sit down and go through it, we can sit down and go through it. And then we're even going to throw in this retirement lifestyle worksheet. This is just going to help you calculate exactly what's going on with your balance sheet, right? With your expenses. So you can come up with that protected income number. So you know for sure what that is. You're not just guessing. So we're going to let you take back control of your retirement, okay? Shortfall analysis, retirement lifestyle worksheet, the ultimate guide to the retirement of your dreams. Now you may have a couple questions. These are the 3 that I get from everybody. Well, what if I already have an advisor? Well, like I said earlier, that's okay. That's great. I'm glad you have an advisor. I'm glad you're talking to an expert who has been helping you. Everybody needs that. Again, I'm not telling you to fire that advisor. I'm saying that we should still talk. Maybe that there's a different expertise that they have been doing for you than I do. Remember, I'm calling myself a distribution expert. In other words, I'm making sure on this back end that you never run out of money. That's different than what you've been doing all these years to grow it. So yes, if you're working with an advisor, no problem, no big deal. You can even take this report to your advisor if you want. It doesn't hurt my feelings. Everybody needs a second opinion, right? Will you be sold something in the appointment? No, I'm not selling you anything. I'll give you options. I'll give you ideas. I'll answer questions. I'll give you information, but I'm not selling anything. I'm not charging you anything. I'm not there's no cost to you on this. We're just going through options. And then I get this one all the time. How much do I need to have in my savings? What do I need to have in my retirement account? How can I even work with you? You guys, it's not about that dollar amount. Remember, I'm not working with, okay, what's this overarching huge total assets that I've accumulated over my lifetime? Well, if it's 100, if it's 1,000,000, if it's whatever in between, it's all about what you're doing to create that protected, guaranteed income in your lifetime. And so if maybe all we do is shift a couple of things, I'm not trying to add anything more to it. So again, I want you to take back control of your retirement. I want to help you do that. Remember, this could be the most important conversation you ever have if all it does is help you avoid paying more taxes than your current plan is going to cost you. What's that worth to you? As I look at this screen, right, this comes back to what your retirement goals are. If I don't know your dreams and your goals and your wants, I can't create the plan for you that you want. So I need you to share as much information as possible, but I also want you to dream. I want you to think about what it is that you want for your retirement. I talk to many people and their answer to me about when they're going to retire is 6 feet under, right? They're going to work until they die. Like, well, that doesn't sound exciting, right? I want to bring hope back into your lives. I want you not to worry about the stock market. I don't want you to worry about a pandemic coming, right? I want you to have a retirement plan that is covered for whatever comes your way in life. So you can see that sign that says work or retire, right? Which one do you want? What's in your retirement plan? This bottom right picture is a picture of Greece. This is on my wife's bucket list. We're going on 10 years plus of marriage. She's wanted to go to Greece on her bucket list for all these times. I'm finally getting to fulfill that bucket list, that dream of hers. In October, we're actually going to France, and then after we're in Paris for a little bit, we're flying down to Athens to do a cruise out of Athens. And so we're going to get to see Greece. It's taken me 10 years to fulfill this for her, but here we are. And you guys, it's awesome. That's so exciting. And I want to know what your dreams and your goals and your wants are. So again, I told you a story about one of my clients. I have a cousin of mine who tragically lost a number of her family members about 2 weeks ago. She had a son, a daughter-in-law, and 4 of her grandkids, all in one vehicle. And they got in an accident. There was a dust storm that came across the freeway. Zero visibility, semis had stopped in the road, and their car plowed into the back of this semi, and it caught on fire. We heard from one of the other semi drivers. They got out, they had their fire extinguisher, they were putting the fire out, looked in the car, figured everybody had died, and went to go help in the next one when they heard a cry. And the 4-year-old that was in the back seat was still alive, and he couldn't get him out. They had to wait until the jaws of life got there to get him out. So my cousin lost a son, a daughter-in-law, and 3 kids all in one accident. So tragic, so difficult, so hard. The 4-year-old lived. I'm just getting goosebumps even retelling the story, you guys. But one of the stories that I heard from them as we were talking through all of this is the one driving, the dad, who him and one of his sons who passed away in this, had a recurring dream that he was going to die in a car accident somehow. He listened to that dream, and he actually went and upped his and his family's life insurance. And as we talked with the family, and they know what I do, I worked with the one who was driving. He was licensed to do this at one point. And they said, we're covered. Things have been put in place. Things are good. As sad as it is, financially, everything's okay. You guys, there's as many horror stories as there are good stories. I have just as many on both sides. So you guys, I want to help. I want to help you. I want to help your kids. I want to help your grandkids. I want to help you leave a legacy, whatever it is that you're looking for. So please, if you want this information, just go to retirementofyourdreams.com, go to shortfall analysis. Let me just show you real quick so that you see what this looks like. So let me pull up shortfall analysis report. Okay, so when you go to shortfallanalysis.com, it's going to say enter the code. That code there is just my name. I'll try to make it as easy as possible. Just type in Jason. When you type in Jason, hit continue. Like I said, it's going to take you to a calendar. Pick a time on the calendar, whatever works for you. And then either Todd or I will meet with you. Once you've booked a meeting, then we're going to send you all this information. Okay. The two documents that we're going to send you, the retirement and the client assessment, those are documents for you to fill out. Once you have filled those out and sent those back to us, then when we get on the phone together, I'll already have that report for you. If you look at it and you're like, I don't know if I want to fill all this out or send this into you guys yet, I'd rather just have a conversation with you first, that's fine. We can fill the document out together when we're on the phone, if that's the easiest, or via Zoom, whatever, web conference, whatever works for you. Just know that if we're getting on that meeting, and I tell you this because this keeps happening, that they get on the meeting, they're expecting me to give them the shortfall analysis report. Well, I can't make the report up until I know what your financial situation is. This shortfall analysis is built off of your personal financial situation. And if you don't want to give that to me before we meet, again, that's fine, right? We can meet, go through the information, then get that report and get back together with that report. Again, once that appointment's booked, that means we know that you guys want the retirement worksheet, the client assessment, and that ultimate guide to the retirement of your dreams. Now, all three of these things are also downloadable documents on my website. So if you go to retirementofyourdreams.com, again, all of those are going to be on there. You can download those. You can schedule a call. You can schedule the meeting, whatever, right? That's one place. This is just the second way to do it, this shortfall analysis. Both of them work. They both go the same places. So I think that covers the bulk of what we run into. So that's all I've got for tonight. Thank you guys so much for sticking with me. I'm going to go through the chat here, see if there's any questions I missed. I'm going to pull up the Q&A. If there's anything I haven't covered, feel free to start typing those in. Again, I'm going to stay on here. We've got a bunch of people that are still here. I know it's getting late, especially if you're in the Central or Eastern time zone. So again, I appreciate you staying on. I'm going to stay on as long as you guys stay on, and I'm going to just start answering some questions here. So let me get a drink real quick and kind of start sorting through the questions and comments and concerns that we've got here. Awesome. Looks like we got another Yankees fan out there. I'm a Yankees fan. Love me or hate me. Doesn't seem like there's any gray area when it comes to the Yankees. They either love them or they hate them. Milwaukee Brewers. Houston Astros. More Dodger fans. Can't say that I'm a Dodger fan. Oakland Athletics. Nevada doesn't have a baseball team, so now a Raiders fan. Yeah, I get that. Again, I'm in Salt Lake City, so I'm only about 6 hours from Las Vegas. We don't have an NFL team either, so kind of by default, the closest team that you're to kind of becomes someone you root for. So I've kind of become a Las Vegas Raiders fan. I used to live in Denver, Colorado. Never was really a Broncos fan. My football team is actually the 49ers. Again, love them or hate them. Okay, so looks like I got two really good questions here. So again, a lot of these questions are answered on my website, the one I've got up here on the screen. So if you go to that website over here on the blog, you will see that as you click on that, there is a long laundry list of videos, and I'm updating those constantly. So I'm always adding more and more videos as people ask these questions. And I've answered some of those here, but let me just answer real quick here because you asked and you want to know. One of them is a question about rollovers. I'm not sure I understand the question completely, but let me just talk to you a little bit about rollovers. So moving money from a 401k or an employer plan. So that could be a 401k, 401a, 403b, TSP if you are a city or a state or a federal employee. Any of those provider employer sponsored plans, okay? Most of those come into play when you turn 59 and a half. There are very few options out there that allow you to move any money from those accounts before you're 59 and a half. A lot of them allow you to move money once they are 59 and a half, but not all of them. Some of them make you wait until you have actually retired, you've actually separated service, you've changed jobs, you don't work for them anymore. In the scenario of my client that was in Alaska, they took it even one step further, that he actually couldn't move his 401k money until he had been separated for service for 60 days. So he had to retire, wait 60 days, then he can move the money. Anyway, there's a lot of terminology that comes with this. So rollover just meaning that you roll it out of that plan with your employer and you roll it into a like-to-like product, right? So you roll it over to an IRA. When you roll it over to an IRA, there's no cost for you, there's no taxes for you, nothing changes because you're just keeping it in a tax deferred plan. One's called a 401k, one's called an IRA. You just move it into that, okay? Now, when you do that, there are a lot of options. There are a lot of options in how that can be structured. There's a lot of options how that can be set up. You can do that with a pension, right? Most pensions tell you that there's a lump sum option, not just a monthly payout or an income option. You can roll over a lump sum of a pension plan. The other terminologies that you come across is a conversion, right? Or, how does that become taxable? Well, I talked a little bit about the IRA, the Roth IRA, and the contribution limits. And I made a comment in there that, that's only on the contribution, not on a conversion. So a lot of these words and terminologies are interchangeable. I actually talk about all these different verbiage on one of the videos on my website, but let's just say this. If you are changing it from tax deferred, 401k, IRA, 401a, whatever it is that your employer plan is, TSP, if you change it from tax deferred to taxable, that means you're actually going to do a Roth conversion. Instead of taking a withdrawal and put it in your pocket, kind of acts like the same thing where you do a conversion. But in a conversion, there's no limit on a Roth conversion. Even though you can only put $6,000 or $7,000 a year into a Roth, when you do a conversion, there's no limit. So if you had $1 million in your 401k and you said, okay, I want to take this $1 million and I want to move it all into a Roth. Well, the only problem with that is that you're at that point then going to have $1 million of income showing for that year, right? Because it's going to be taxable at that point. And so you would actually have to move that $1 million and hold back 30, 35, 40% of that in your pocket to pay the tax bill. So that may not make a whole lot of sense. But as we do the numbers and converting it to a Roth and paying taxes now while taxes are low, while taxes are what we know they are, while taxes are what we can manage right now rather than the unknown of, well, I'd rather pay taxes at 30% now or 25% now than I would at 50. Well, of course we would, right? But what we can do is over a couple of years, right? We can do a Roth conversion ladder. So we can control how much we convert each year, okay? That is probably the number one piece of advice that I can give in generics, is that most of the time, a Roth conversion is more beneficial. And I say that now because we know where our tax rates are now. Over time, as taxes go up, that may not be the best solution, but it is the best way to get a max amount of money out of your tax deferred and into your tax-free bucket. Because think of it this way, right? If you can move $100,000 of tax deferred into tax-free, yes, that's going to show up as $100,000 of income. And so if you have to pay 25%, $25,000 of taxes on that 100,000, then you only put $75,000 into your Roth. And this is the conversation I have with everybody every time. But I have $100,000 earning interest for me, right? Compounding off of 100. Why would I take that and make it 75,000 and only be compounding interest off of 75? Well, here's the main reason. Let's say you grow that 100,000 to 200,000. Let's say you grow that 75 to 200. Well, when you start pulling money out of that $200,000 that you grew in that tax deferred bucket, you're going to owe taxes on all 200,000. If the 75 in your Roth went from 75 to 200, you owe no taxes on that money, all 200,000 of it. So where's that break even? Is 75 doubling it to 150 versus 100,000 doubling it to 200, paying taxes on 200 versus 150 and no taxes, right? There's some math involved. Again, I'm not a CPA. I'm not an accountant. We will get your CPA involved. We'll make sure we know where your tax brackets are for that given year. But word to the wise, most CPAs, their job is to save you in taxes, right? And you're going to come back to them each year because they saved you taxes. They got you a tax return or whatever. They're taking care of you today without looking at what you need in the future. Is that bad? Is that wrong? No, they're doing their job. They think you're trying to pay the least amount of taxes. Well, we all are. But when it comes to retirement, I want the least amount of taxes in the future when I'm living off of a fixed income and still have these expenses. So if you can get a CPA to work with you, to talk to you, to meet with both of us together, so all three of us are talking. I talk to CPAs all the time to help say, no, we're not trying to get the least amount of taxes today, because the least amount of taxes today are going to cost us more taxes in the future. And as we have that conversation, yes, they understand what I'm talking about. They just didn't think that they were going to keep you as a client if they did that. But if we can make sure that we save you the most amount of taxes in the future, that could be a huge difference. Again, there is a dollar amount that makes sense to keep in your taxable, tax deferred bucket. But there's a lot of math that comes involved in that, right? We want to make sure that we keep as much of our Social Security as possible. If we have income coming in from other sources, then they're also going to be taxing our Social Security. Well, there is a way, there is the ability, this goes along with another question I got, you can get all of your Social Security benefits to you 100% no taxes. But if you've got other income coming in, then half of your Social Security could be counted as income and dump in your taxable bracket, in your taxable income, your adjusted gross income. If you have enough income coming in, 85% of what you get from Social Security is going to go into your taxes as income, and they're going to tax at whatever the tax rate is. So do you want to put your Social Security into your taxable income or none of it? Well, of course we want none. If you have a pension, there's only so much that we can do. But that's extra income. Okay, so we talked about rollovers, moving money out of an employer plan, talked about Roth conversions, a little bit about Social Security. You guys, man, we're going on an hour and 46 minutes that I've been talking, and my throat is dry and killing me. So I don't see any more questions. Todd, hit that chat or type in the questions if there's anything that I missed. Again, if you're looking for more information, please jump onto my website. You know what? Real quick here, while I got you guys still, since you're here, I'm gonna look at my calendar real quick. Some of you probably got a phone call earlier today. See if they can get you on my calendar, because my calendar tends to get booked up pretty quickly after I do these webinars. And for tomorrow, all right, it looks like I have a Jorge that scheduled an appointment tomorrow. Awesome. Thank you, Jorge. I got one on Monday with Yolanda. Awesome. Awesome. One on Tuesday. Oh, hey, Michael, you're still on here too. Looks like you booked it in there on Tuesday. Awesome. We'll get you the information that you need for that. Francisco, looks like you're booked. Great. Well, at least I know it's working. Looks like it's working. Sometimes we have technical issues and things don't come through, but awesome. Claudia, you're welcome. I look forward to talking with you. You have a good night as well. Awesome. Okay, looks like I got everybody scheduled. It looks like I got all the questions answered. You guys, thank you so much. Feel free to contact us for anything you're looking for. Again, feel free to use my website. It's all free. There's no cost to you. So I appreciate everything, and you guys have a wonderful night. Talk to you later.